Well, welcome back to Finance Uncut. On today's episode, how to get rich in a market crash. And coming in from Yahoo News, IMF warns of economic collapse unless G20 extends debt relief. And coming in from the Australian, market now is crazier than the dot-com era, says Berkshire Hathaway Vice Chairman Charlie Munger. And this from Zero Hedge, hedge funds are liquidating at a furious pace and retail investors are buying it all. And here in Australia, new loan commitments was down 4.1% in October on the back of a 2.7% decline the month before in September. So you'll see here, really in the last 12 months, there's been a huge spike in new loan commitments, something that we've never seen before. So when people ask me about the property market, I say it's not sustainable based on the trajectory of new loan commitments. It's just not. We're now seeing that roll over. So keep a very close eye on this to all my Aussie homeowners and Aussie housing investors. And OECD warns, you know that word, may intensify supply shortages and inflation. And this chart shows the US leveraged finance new issue volume. You can see institutional loans hits all new highs. High yield bonds as well. And you'll see in a chart shortly that buybacks, corporate buybacks, have also hit all-time highs. And coming in from Market Watch, in his final warning, this stock trading wizard who made big money in bear markets and crashes called this market a bubble like no other. Veteran trader Mark D. Cook, who passed away recently, closely monitored the market's health and was convinced that US stocks are due for a major hit. So those who do not recognize who Mark D. Cook is, you may not be familiar with that name. You may have read some of Jack Schwager's books, The Stock Market Wizards. Well, he was in one of these. So Mark Cook, a veteran options trader who was featured in author Jack Schwager's best-selling Stock Market Wizards book, passed away in late October. I had planned to speak with him to discuss his bearish views on the US stock market, which grew more ominous each week and shared in his twice-daily market advisory service. Cook was an old-school S&P 500 futures trader. He made his first $1 million in the wake of the 87 stock market crash by loading up on put options before the downturn, thanks to the strength of a signal from the New York Stock Exchange tick indicator he closely followed. Cook had other big stock trading successes, including a 563% audited annual return in 1992, followed by a 322% annual return in 1993. Cook is also known for anticipating the 2001 and 2008 US stock market crashes and made a small fortune betting against the market. In recent years, he predicted the US bull market, which began in 2009, would meet a similar fate. He and I even collaborated on a book about bear markets published in 2015. In our most recent conversation, Cook said he was convinced that this current bull market was on its last legs. He said it had gone on too long and gone up too high. Think of a vacant building that has a gas leak, Cook once told me. The gas has been leaking for a long time. The longer the gas leaks, the bigger the explosion. It would take a catalyst to trigger an explosion, but no one knows what the trigger point. What is a trigger point? The longer the gas is in there and ignored and forgotten, the greater the explosion. The stock market, he said, is like the vacant building. When it blows, the result will be horrible. He expected the worst to hit this market. Cook often said that his warnings were not meant to scare investors, but rather to help protect them when a bear market arrives. He was also flexible enough to turn bullish after a crash, which he successfully did after 2008. Yet by 2016, Cook had become infuriated by the Federal Reserve's bond-buying spree and felt that financial markets should be left alone, without central bank interference. Amen to that. By this year, Cook was convinced that the US market's valuations had inflated into its biggest bubble ever, and when it popped, it would devastate both the US economy and investors' portfolios. Clues that a bear market is near. Although it's tricky to predict when a bear market is near, there are clues. Here are some of Cook's key signals. Number 1, watch how the S&P 500 rallies. Cook paid attention to the S&P 500 rallies were weak or failed. He said you can tell the strength of the market more by the way it rallies than the way it declines. He called them one-day wonders, meaning you may get a 1 or 2% rally in the S&P 500 or more that didn't carry over to the next day. Even more alarming, if a strong early rally reverses direction by the end of the day, Cook saw it as an important warning sign. Typically, in a bull market, strong and healthy rallies continue not just for a day, but for several consecutive days. Number 2, the buy on the dip strategy fails. Buying the dip works brilliantly in a bull market, but it fails during a bear market. When the buy the dip traders punish, Cook knew it was time to either switch strategies or risk getting mowed down. Number 3, prices are always the last indicator to fall. Cook often said that the public watches stock prices for clues of a bear market, but that prices are the last domino to fall. No one knows what causes a crash or a bear market. The catalyst usually comes from a source that no one has foreseen, hitting a market that is already weak. Prices plunge and everyone realizes the market is in serious trouble. According to Cook, the clues were obvious weeks or even months earlier. Crashes are not welcome. Cook did not like market crashes because they killed volatility. He often said the crashes are not good for anyone, especially traders. Cook thrived on volatility to make money. He preferred an occasional 10% correction to a crash. He told me he made most his money during corrections and bear markets. It also bothered Cook that he made money while so many investors suffered. Short sellers such as Cook are often despised and even blamed for market crashes. Cook had to deal with being called names and not being invited to share his views on typically bullish financial news shows. Cook's to-do list. Here's a list of some of the ways Cook was able to thrive during crashes and bear markets. Keep in mind that these strategies are primarily for traders. Number 1, sell long positions and move into cash until the storm has passed. That's certainly an option. Number 2, buy put options on the S&P 500. That's a great way to hedge and protect yourself. You protect your overall portfolio, so you don't have to sell all your shares. You can just buy puts on the S&P 500 or whatever index that you're invested in. Buy inverse ETFs. There's here in Australia you can buy BBuzz ETFs. Not a huge fan, but anyway. Or you can short individual stocks, or you can buy put options on individual stocks. And we did that in March last year. I've shared this story that in March 2020, I think it was the last weekend of February, I went away to Mount Tamborine for the weekend. It was our anniversary. And all I could think about that Friday, I was going to buy put options that Friday. And all weekend, all I could think about was come Monday morning, I was buying put options on a bunch of stocks. And so I did that. And within 2.5 weeks, we made 780% return on that. So that they were fantastic trades. Cook said the most prudent strategy for many traders is to move into cash or sell stocks to a point where they're comfortable. Moving to cash is not designed to make a profit, but to protect your portfolio and also to be ready to take advantage of future investment opportunities. And that's the other thing is, if you just sell, move into cash, wait for the market to fall, and then buy back in again, that could be a good strategy. For us, we like to, as I said, we like to short, we like to buy some put options, make some extra capital, and then redeploy that capital. Cook said that you must know how much pain you can accept, i.e. risk tolerance. If you can handle a 30 or 40% downturn, then stay the course. If not, move to the sidelines. Another key to surviving bear markets and crashes is diversification. If your portfolio is diversified, there is no reason to panic, which is what many people do when the market loses 20% or more. And I've argued this also. In March last year when the markets fell, 35, 36%. Gold fell, 10%? 12 maybe? I can't remember the exact number. So once again, if you're diversified into gold, sure, cash will hold its purchasing, increase its purchasing power in a market crash. but gold will do well as well. Gold will do very well. So, yep, that's another option is diversifying, but each to their own. Cook left other valuable nuggets of trading wisdom. One thing that must be stressed, he wrote, is that bear markets are not bad. Think of corrections and bear markets as trading opportunities. There is a pause in buying and then an all-out run for the hills when the grizzly is on their heels. When a bear market arrives, people descend into irrational thinking and actions. It always happens. He added, take the opportunity to learn about downtrending markets. You should also prepare for the next bull market that will emerge once the bear market ends. That's when you can really do well. While trading on the short side involves good timing skills and experience, it's easier to trade in a rising market. So some wonderful wisdom, some wonderful pieces of gold in that article right there. So check this out. Phil King from Regal Funds Management. His stock pick is short Flight Centre. Why I found this interesting is because in March last year, Flight Centre was one stock that we bought put options on, and we bought put options when the stock was about $32, $34 from memory. It was over $30 anyway, and we shorted it all the way down to about $12. So that was very profitable. Regal Funds Management co-founder Phil King is recommending that investors sell shares in travel company Flight Centre, arguing that the stock has rebounded too strongly since its lows of last year, but the company is still facing headwinds with the shift to online travel bookings. King, who's the only fund manager at the Sohn Hearts and Minds conference, tipping a short, said Flight Centre shares have doubled from a low of $8.75 last year with the onset of the to the current levels of around $17.33. We think it is too much. We think it is a short. King said Flight Centre, whose shares peaked at $69 in 2018, was a popular stock with retail investors who saw it as the go-to stock for the reopening of the economy. But he said that while people were excited to see the international borders opening up, we think it is going to be a bumpy road out of lockdown. Mr. King compared Flight Centre to US company Zoom, which had been a market favourite last year as the world discovered its products, but its shares had fallen this year as investors became more skeptical about the company's long-term financials. So in this chart, we've got the leading economic index and the coincident economic index. And what I'll share on this one is obviously the leading economic index does exactly that. It leads the CEI, and when the CEI falls, then we go into recession. So all I'll say is keep an eye on this. If we see the LEI roll over, look, if you even look at the CEI, it's now looking weak. But keep an eye on the LEI. That's a leading indicator. And then the CEI follows, and usually that means we end up into a recession. And in this chart, so I think it was the third quarter, S&P 500 buybacks hit a record high. So obviously, when you've got this level of buybacks, it is going to pump up equity prices. So, yeah. And there's a couple of things to note in this chart. Whenever we have had interest rates hit very low levels, usually after a crash of some sort, that has been the prime time to buy assets to go risk on. And had you done that, you would have done extremely well. But when interest rates reach a certain high, it's then time to roll out of those risk on assets. Now, the only problem we've got now is because asset prices are so high on all sorts of metrics, and because it's funded, because it's been ultimately funded through debt. So whether you want to look at margin debt at record level highs, housing debt, record level highs, corporate debt, you name it, debt. We're in a debt bubble, okay? We don't need interest rates to hit the levels that they did in the tech bubble and the housing bubble to pop this thing. The only question is, what is that level of interest rates that will pop this thing? How high the central banks need to go before this thing pops? Or can it pop on its own? That's the big question. So I've shared in a recent video my position, my trade idea on my Aussie and US dollars. So I'm not going to go into that. If you want to know more about that, I'll put a link in the description below to that video where you can watch where I talk about this trade. But pretty much it's a Brent Johnson dollar milkshake theory trade type of thing. And yes, I am bullish gold and miners and explorers and silver and commodities. And I'm on the inflation bandwagon. But I also get during a market crash and liquidity events, there will be a rush to the US dollar. As much as we might think that the US dollar is, what it is, there will be a rush to the US dollar, and there will be a selling of the Aussie dollar. And obviously asset prices will get hammered, and this will work out very well for me. And I've shared this chart before as well. Correlation's pretty good, right? 97.2. Major central bank assets and S&P 500. So if we do start seeing tapering, if we do start seeing interest rate rises, well, what is this going to mean? And I've also shared this chart before. So this is flows into equity. So we've had in just this year in 2021, we've had nearly 900 billion or 9 billion, 900 billion of equity capital flowing into equities, which equates to the last 19 years combined. The question is that now rolling over? Are we seeing capital coming out? Well, it seems it is, right? Based on Zero Hedge, that article. And I shared this before, smart money index. Yeah. So if the smart money, if the hedge funds, if the financial institutions, the institutional investors are exiting the risk on market, retailers are picking this up. I mean, guys, seriously. And I haven't shared this chart for a little while, but this is performance of hedges in market sell-off. So when we had the 72, 74, 87 market crash, the dot-com bubble, and the GFC, you saw the stock market there. In fact, to be honest, I don't know the exact dates there, but I know that 73, 74 period, the stock market fell almost 50% in nominal terms. And, this is where people are moving out of risk on assets. They're moving into risk off. And you can see that gold performed very well during those big market sell-offs. And, as I said last year in March 2020, the market crashed, 35%. Gold was down 10%. Had the market continued to fall, and even if it didn't, if it just sustained those lows for a little bit longer before the market really bounced back up on just insane liquidity. But let's say that market fall lasted a little bit longer, we would have seen more capital flowing into gold. So that little 10% correction in gold would have come back, and I believe we would have seen a positive marker on gold in a very short period of time. In the end, gold did quite well up until August. But yeah, this is one argument why gold should be always part of someone's portfolio, whether you're looking at the Dragon portfolio of 19% or others say 10%. Gold should always, in my opinion, be part of everyone's portfolio, whether we're in inflationary times or deflationary times. It just makes sense to have it. So anyway, that's my opinion. What do you guys think? Love to see your thoughts and opinions in the comments below. What way are you protecting for this market crash, which I believe is happening, and I've been saying that for a long time. Yes, I'm on the inflationary bandwagon, but I have said that asset prices can get hammered in between that. Just like it did in 1973-74, where we had CPI at 12.5%, yet we had a 50% fall in nominal terms in regards to the stock market, even though I know this chart says 39.5. So it can happen, and I think it will happen. So I'd love to hear your thoughts. I'd love to see how you guys are protecting yourselves or hedging, or what your plan is for this market crash. Yeah, love to see your thoughts and opinions in the comments below. Don't forget to hit that like button if you like this video. Take care, everyone, and I'll see you again on another episode of Finance Uncut.